There are two types of taxpayers: those who pay everything the government demands of them and accept taxes as an inevitable part of life, and those who will stop at nothing to avoid doing so. The US Secretary of State claims that Warren Buffett pays less tax than his secretary. Welcome to Financial Fluence. In this video, I'll teach you how the rich hide their money and pay no tax. Let's now get going. Call the tax evader Jack and the stubborn Paul. Paul believes that because he earns $40,000 annually, the government showing up at the end of the year is not a big concern. Paul resumes his life after paying his $15,000 in income taxes. Despite the fact that he would undoubtedly like to keep more of the $15,000, he views paying taxes as a necessary part of life. Jack, on the other hand, created his own IT company from scratch and now owns a medium-sized business that pays him. Jack dislikes paying taxes, as opposed to Paul, who does so gladly and employs more than 50 people. How can the government take such a significant chunk of it when it had nothing to do with his company's success? Since Jack is liable for both personal and business taxes, such as sales taxes, excise taxes, property taxes, and investment taxes, he decided to examine the potential tax burden on his income. Jack was looking for tax methods, and he discovered the first of the following. Number 1. Writing off expenses. The wealthiest people can deduct their expenses and taxable income because they make their money through business. If you run a digital marketing agency and make $200,000 a year, you can deduct your expenses to lower the amount of income you have to pay taxes on. However, because most businesses incur expenses, the amount of profit subject to taxation will be reduced. For example, if you have $100,000 in reasonable business expenses every year, your annual profit would be $100,000 rather than $200,000 in income, resulting in a greater than half-year tax savings. Expenses include business lunches, office supplies, new laptops, internet connections, employee benefits, staff training, rent and leases, car expenses, and so on. Number 2. Diverting income. While the corporate income tax rate in the United States dropped from 35% to 21% in 2017, several corporations, like Amazon, chose to register their earnings in nations with even lower tax rates. The Cayman Islands, for example, have no income tax, corporate tax, estate or inheritance tax, gift tax, or capital gains tax, making it a pure tax haven. In short, you keep all you make, which is obviously a big savings for any business that can realize their money overseas. But how much money would you save if you established a tax haven in this country? For example, if your company made $5 million last year, instead of paying 35% income tax on $1,750,000, you would pay nothing and pocket over $2 million. Aside from allowing you to realize income tax-free profits, the cane has extremely rigorous banking rules designed to protect financial secrecy. Also, the government does not have tax agreements with other countries. This keeps foreign tax authorities from getting access to the money of its offshore banking clients. Furthermore, offshore corporations in the Caymans are not required to submit financial reports to any Cayman's government authority, and incorporation in the Caymans is a very simple, streamlined process. With all of these advantages, it's no surprise that businesses are flocking to these remote locations to hide their earnings. Number 3. Netting revenues against losses. If you've ever looked at the statistics in favor of starting a business, you'll understand how discouraging they may be. Statistics show that 20% of small businesses fail in their first year, 30% fail in their second year, and 50% fail after 5 years. Finally, 70% of small business entrepreneurs fail by the 10th year. Despite the fact that the chances of company success are very low, there are still many organizations that succeed and create a fortune that they need to safeguard. And one way they accomplish this is by using loss carry-forwards. Most businesses take several years to break even, and losses are unavoidable in years when business is slow. While these losses are unpleasant at the time, they are long-term tax avoidance methods. Loss carry-forwards can be used to offset earnings, lowering your overall tax bill and allowing you to keep more of your earnings. And before we continue, don't forget to subscribe to the channel, hit the like button, and turn on the notification bell to be notified every time a new video is uploaded. Let's return to the video now. Number 4. Issuing stock options. Giving stock options to shareholders is another way for businesses to save money on taxes. This method is extremely beneficial to businesses for 2 reasons. First, it is initially represented as an expense, which affects profits and ultimately the amount of money that is taxable. Second, the company has no cash outflow. When stocks are issued, they are counted as an expense for accounting purposes, but no cash changes hands. This suggests that the corporation can reduce earnings through expenses while keeping a strong cash position. This method benefits businesses since it encourages shareholders to raise the stock price. If you work for a company, wouldn't you go out of your way to enhance the stock price and use these 4 corporate tax planning tactics to increase the payment of your options? Number 5. Leveraging geographical tax laws. For the past 20 years, Jack has established his firm in the heart of Silicon Valley. But his patience with living in the state with the highest income tax rate in the country has finally worn thin. The state income tax rate for the highest income earners is 13.3%. When Jack started looking for places with lower income tax rates, he was shocked to find that 7 states, including Texas, Nevada, and Florida, had no income tax. This allowed Jack to avoid paying the 13.3% tax while still basking in the sun's warmth throughout the year. Number 6. Investing in real estate. One reason the wealthy continue to gain wealth is that they put their money to work for them, with real estate being one method. You can save money on taxes and enhance your wealth by purchasing a property. You must own a depreciable asset, which is something that loses value over time. Because it loses value, you can deduct it from your taxable income. Property repairs and mortgage interest are both common tax-deductible expenses, and the more you spend, the more you save. But what happens once a property's depreciation is complete? You sell it and buy a new one. If you acquire a new house within 60 days of the sale, you can defer the tax you paid on that sale through a 1031 exchange. Number 7. Deferring income. While Jack has considered moving states and investing in real estate to decrease his taxable income, he still believes that some of his income should be tax-free, which he can do by deferring his income. The most common way to put off paying taxes is with an individual retirement account, or IRA. With an IRA, you can put your income into a fund and pay taxes on it later. You almost certainly use this type of account to save money and watch it grow over time if you work. However, they are a fantastic tax avoidance tool. Unless you contribute to your IRA, money earned from employment is taxed. If you contribute to your IRA during the year in which you contribute, you'll receive a deduction from your taxable income, or the amount donated, whichever is greater. This strategy is especially good for people with high incomes because it lowers their tax burden when they are making the most money. If you earn $500,000 per year and pay the maximum tax rate, your earnings could be taxed at up to 40%. Instead of paying the entire 40% of your income in taxes, what if you could just pay 20%? With an IRA, you can precisely achieve that. You don't pay taxes when you make contributions to your IRA. Rather, you do so when you remove the entire amount from it, which is frequently when you retire. The difference in tax rates determines how much you would have saved by using this income deferral strategy. With all of these tax evasion strategies at your disposal, you just have one choice. Will you continue to be a Paul or a Jack taxpayer? And that's all. I hope you enjoyed this video. If you enjoy similar stuff, check out my other videos. And if you like it, hit the like button, subscribe to the channel, and turn on the notification bell. And I'll see you in the next video.